What's going on, everybody? Welcome back to my channel. So I thought for our first lesson this week, let's talk about the 3 stages of trading and how we can actually trade them. So I follow a simple strategy based on market structure and market behavior. And that simply means when the markets are in their 3 phases, I do one of 3 things. The 3 phases of any market structure is clearly a trend to the upside, making higher highs and higher lows. The second is a trend to the downside, making structural lower lows and lower highs. And then the third phase is a ranging market. Now, clearly, we want to be trading with the trend. When the momentum is in play, we want to be taking buys to the upside. When momentum is in play, we want to be taking sells to the downside. So for me personally, when it comes to ranging markets, this is something I don't mess around with. When the markets are moving to the upside, I'm all for it. And when the markets are to the downside, I'm all for it. Now, I don't have any secret formula to know when the market's going to trend, when the market's going to stop trending. But what I do know is that the probability of me making money when trading, when the trends are in play, are much higher than me trying to anticipate a reversal or trying to figure out what is the best time to take a breakout or take a trade at resistance or support or whatever you want to call it. So without further ado, let's take a look at the 3 patterns that I personally look for when trading continuation trades. Now, when the market is trending to the upside, we all know that the market will make a new higher high, and eventually for a continuation, it will exhaust, pull back to make some sort of higher low before then continuing to the upside. So when I'm trading, I want to be able to anticipate when is the best opportunity to buy the market. When trading with the trend, there are 3 exhaustion patterns or pullback patterns or whatever you want to call them patterns to be looking out for. And the first one that we're going to look at today is on pound yen. And that is a very strong trend to the upside with a very small pullback before a continuation. Now, we never know when the pullback is a true pullback. So we have to look for key factors to identify them. That could be through wick rejections, that could be through engulfing candles, that could be through absolutely anything that is part of your strategy. But what I'm trying to illustrate now is a normal or a general pullback is something that will look like this. A nice pullback, strong, clean and clear. But that's not what we're talking about today. We're talking about a strong push to the upside, a very, very subtle pullback before a continuation to the upside. So how do we trade this? Well, let's take a look at GJ, and I've marked off an example here. Now, I haven't done the replay mode because when I do the replay mode, a lot of people following me in the community here on YouTube say, well, you've just done the replay mode and you've just done past data. So I thought, you know what, let me just leave the replay mode this time and let me just illustrate this. So first things first, what we can see on this market structure is the market was moving sideways. Now, I'm sure all of you would agree with me. We can see price wasn't able to break above structure for a very long period of time, and eventually we made a new higher high. Now, once the market makes a new higher high, to validate this breakout and this potential continuation to the upside, what we want to see the market do is pull back to create what we know as being a trend to the upside, which is that higher low. Now, again, we don't know that the higher low is going to continue to the upside, creating an uptrend, but once that higher low has made the higher high, then we can validate that the structure has changed. So here you can see on this market structure, we have the higher low formation, and then now we have the new higher high formation. Once we have this structure built, we do not need to worry about the consolidation anymore, because the behavior that was once a consolidation is now a trend to the upside. So going back to the pattern that we was talking about, we were looking for the market structure to show a clear trend and then show us a very aggressive pullback, higher low formation before a continuation. Now, if we take a trade with a higher low formation that's very aggressive, we're not going to know whether this is going to be the true pullback, whether market structure is going to hold, and whether the market is going to continue to push to the upside. So what we need to happen or allow to happen is for this market structure to create a level first, confirm that that's a level with wick rejections or strong bullish candles to the upside, and then we need to see the market come back to that level before continuing, and that will create a double bottom pattern that will help confirm that the trend is still strong. The level that we're trading off of is strong, and we know that we can be sure that if we place our stop loss below this level, then we should be in a good place to be trading. So let's remove all this red off the charts. Let's take a look at the example that we have drawn out here. We have the breakout, the consolidation, the first higher low and higher high, and now, as you can see here, we have a level created in the market. Now we want the market to leave to indicate that bullish pressure just for a period of time. It doesn't matter how long. We just want the market to indicate that bullish pressure. Once we have that bullish pressure, then we want the market to come back to this level. Once the markets come back to this level, there's two ways you can be entering this. You could be scaling down to your lower time frames, looking for early signs of price reacting from this level, or you can do what we've taught before as part of the sniper entries video, is we can set a sell limit at this level. So once you identify that the level has been created from that higher low, after the higher high has been made, then what you can do is you can set a buy limit, should I say, at this level, and just anticipate price coming back to tap this level to create this pattern that we know is a very powerful pattern in line with the uptrend, and then wait to see if the market comes back. If it doesn't and it continues up, you missed a trade. It is what it is. But if it does come back, then at least you get triggered into the trade. You're trusting the pattern itself that is proven that it's going to hold and be strong in line with the direction of the market. With your stop loss, it really is down to you and what you're comfortable with in terms of the stop loss size. Me personally, on a pound yen pair, you could be very comfortable with a 25 pip stop loss on a buy limit order and simply just go for your 1-to-3 risk to reward ratio. Now again, I'm not here to teach you risk management. I'm here just to share a pattern with you that I find to be very powerful in the markets and one that you can use in line with trend trading. So now we see the trend is up, higher formation is formed, the higher low with a very aggressive pullback, no wick rejections. And now what we want to see is the market leave to confirm that there's strong bullish pressure or an indication of bullish pressure in and around this level. Let the market come back, see what it wants to do in terms of its reaction. Make sure that when you're buying this, you have a 1-to-1 risk to reward ratio to go break even before price gets back to this level, which we do, as I always say in every single video I do, and then go for your 1-to-3 target. And as you can clearly see, a super powerful pattern. Now we can highlight this again on the same pair. After the breakout of this structure, look what happens. A level was created and then price came back again. Same thing here. You can do it every single time. It's completely fine. In an instance like this, if you have a wick, just place your stop loss below that structure and then again go for your 1-to-3 risk reward ratio. It is completely fine. But again, you guys have to go and back test, forward test, and just find out if this is something that's tradable for you. How you enter this is down to you, obviously, but this pattern is a super powerful pattern that you could be trading. And just remember, these patterns usually form when a trend is to the upside or downside and there's a really aggressive pullback that is not as clear as a pullback like this. You just want to see the market leave, come back, retest this structure just to confirm the level strong, and then look for that buying opportunity. So that's pattern number one. Let's move on to pattern number two. So for pattern number two, we're looking at USD CAD here, and what we understand as part of a pullback is the market will create lower lows and lower highs and higher lows. Now again, we can never anticipate how far the market's going to pull back, but what we can identify is a few different things. When the market is trending beautifully, you'll see the market push to the downside, pull back, push to the downside and pull back. But what happens when the market really overextends? Can we really validate a pullback looking like this when we know in theory the market likes to pull back or give a true pullback before continuing to the downside? The reason why I'm saying this, and you might not understand now, is any sell or buy we take is a formation of a single candle on the higher time frames. If a candle, let's say this is the 4H trend, and this is a weekly candle that's pushed to the downside extremely strong. Now, the likelihood of this candle continuing to push to the downside if it's met its range is very unlikely. So what the market would want to do on the weekly time frame, if we're trading the 4H, is at least create a pullback to 50% of the previous candle before continuing down. Just to create a wick or just to create a pullback. And this pullback in itself will clearly take out a stop loss that's above this structure with this strong push phase. So how do we trade it? Well, what we want to be doing in any instance like this, knowing that's how the market moves, if the market gives us nice pullbacks and then eventually gives us a very strong move, we want to anticipate that the pullback is going to be strong. So instead of looking for a pullback that will look something like this, we want to wait for the market to give us a true pullback and then look for the continuation, just so that the high time frame candles will have enough range to pull back to create a wick before then continuing in its bearish direction to the downside and continue this trend on the 4H time frame. So when looking at USD CAD, what can we see? Well, with this market structure, we can see a nice little push phase, a very aggressive or subtle pullback, as I just mentioned on our first example, another push phase, another small pullback, another push phase, another small pullback, another push phase, another pullback, and then what do we have here? A very strong push phase with this market structure. Now look at the length of this push phase compared to what's happened before. We can clearly see that with this structure of this market, this is a very strong higher time frame candle to the downside. And as we just illustrated, when we have a very strong higher time frame candle to the downside, more than likely what price action likes to do is pull back to around 50% of this candle just to create a wick before then continuing its bearish descent to the downside or in line with the trend, either to the upside or wherever it's going. As we can see with this example here, look what's happened. The market didn't just give us a little pullback or an aggressive pullback for a continuation. The market pulled all the way back to around 50% of the previous move, this strong move to the downside, before creating a level and having that level being respected and then continuing its push to the downside. So when taking these trades, again, take them in line with your strategy. But what you want to see the market do, you could either take it immediately at the pullback, that is completely fine, and then look to go for your 1 to 3 risk reward ratio, stop loss above the structure. Or just like our first example, you can wait for the market to leave the structure for a period, come back to confirm that this is a strong level, and then you can take the trade once the market gives wick rejections, or in this instance, a bearish candle to the downside, and then go for your 1 to 3 risk reward ratio. Very powerful pattern again, and this pattern you must identify when the market has really pushed strong to the downside, looks really extended, and what we have to remember is that's just a very strong high time frame candle that will require, when the new candle opens, or more often than not when the new candle opens, will pull back to create a 50% retracement of the previous candle or the previous leg or the previous push phase, and then look to take those trades. So let's take a look at our third and final example. So for our third and final example, we all know, again, let's just continue with the same analysis. When the market is pushing to the downside, we know that eventually the market will create a level. Now, a lot of the times the market, well, what we anticipate is that the market will make a lower low. Now, if the market doesn't make a lower low, that doesn't necessarily mean that the market's going to reverse. But what the market will likely do is come back to a previous structure, or lower high or higher low, show signs of wick rejection, whatever you want to call this, a liquidity pullback, collecting orders, not enough orders, I don't really care. And then eventually what you'll see the market do is push to the downside. So not every single time will you see the market make that lower low immediately. Sometimes the market will create a level, it will push away from that level, come back, react to that level, and then continue down. Now, just because it hasn't broken the previous structure, this does not mean it's a reversal. Remember, we only trade with the trend, and unless the market illustrates a trend reversal, creating new higher highs and higher lows, you are still sell bias on this structure. So let's take a look at an example here on pound USD. You can clearly see that the structure of this market is to the downside. We have a very strong push phase to the downside. We have an aggressive pullback here, as like in our first example. Another push face lower low, and then look what happens. We never had price pullback to make a lower high or a deep pullback. Price came all the way back to that previous structure level. We see the reaction from this level, and now we have a strong push face to the downside. Again, in line with the trend, which is to the downside, we have a lower high formation that's formed. We have structure that has not broken that previous level, and then as you can see, it's come back. It's attempted to come back into this level, but not really come back into this level. And then again, finally, price has come back, created a wick rejection, and now we see the move to the downside. Now, my point here is, Not every single time will you get a trade taking these patterns, simply because the market may range and that may make you fearful of taking the trade. But what this should highlight to you is if the market has created a lower high or a higher low and price cannot break above that level or reacts to that previous structural high or low, then the likelihood is the market is still going to continue in the trend that it's in, which is either down or up. So these are the 3 patterns that I'm teaching you today. Very, very powerful patterns. Look out for them, back test them, forward test them. Remember, what I'm telling you now is of my own opinion, so please don't go and slam loads of money on all these setups that you see. Make sure you're using proper risk management and make sure you're using your strategy and your risk management plan in line with your strategy, should I say. Okay, that was a bit of gobbledygook there, but I got it out at the end. So 3 patterns. Very aggressive pullbacks. When we see this pattern, what we're looking for is for the market to create a level, come back, confirm that level strong, and then look for those buying opportunities. Second pattern is a very strong push to the downside and allow for the market to pull back to around 50% before a continuation. Final pattern is if the market is pushing to the upside or downside and is failing to break the highs, but decides to come back to the lows, then look for those double bottom patterns. Again, until price breaks and violates these structures, in theory, you're still in an uptrend, so you can continue to look for those buys. So I hope this was useful. As I always say when trading, make sure that you are patient, make sure you are waiting for these setups to develop, and most importantly, trust the process. As I always say, if you've enjoyed this video, please smash that like button, subscribe, and until next time, take care.